Welcome back once again. How are you guys doing? Hopefully well. This is Si Win Yi, and let's dive into another great real-time, very relevant real estate information. So you folks out there can make some educated and informed decision using common sense, rationale, and instead of emotional roller coaster kind of stuff, right? So most important thing is you learn using credible sources, not those clickbait, over the top, just information out there, which is very misleading, very inaccurate. Or those negative headlines, it'll really affect people's mental beings. So anyway, without further ado, let me get this started. All right, today's article is coming from Altos Research, a very high level, up and coming real estate research data company based in Los Altos, California, which is in my neck of the woods in San Francisco Bay Area. Just anyway, and the title is Key Signals to Watch in a Volatile Real Estate Market. Key signals. Okay, so, and the author of the article is Mike Simonson. Mike Simonson is a CEO and founder of Altos Research. They've been doing a lot of great data and has been providing very great information for the real estate marketplace, in case you have not noticed. All right, so in May, Mike Simonson wrote this article, and it's being published to the general public. And let's go over, as usual, I will give you my take on it based on my 30 years of real estate investing experience, and also guiding thousands of real estate investors to buy rental properties in a cash flow affordable markets in selected parts of the US. Okay, so anyway, if you find value in this video, please, at the end, please smash the like button and uh, and join my YouTube channel, right? Subscribe to my YouTube channel. All right, so let's get back to sharing my screen, and here we go. So, and again, the first paragraph is that uh, we have seen the biggest spike in mortgage rates we have seen in decades, and all the signs of a slowdown are here. Inventory is rising. Well, I debate that. Let's go on. The price of new listing is dropping. Yeah, more homes are taking price reductions, and there are fewer immediate sales. And here's the chart: percent of active listings with price reductions, as we see here. Before the pandemic, prior to 2020, we have seen pretty level around between mid 30 to high 30% of price reductions. Then, of course, during the pandemic boom, there are very little price reductions. Everything selling over the asking price. I could give you one example in the area. During the pandemic boom prior to this year, there some houses are sold for $1 million above asking. $1 million above asking. This is mind-boggling. Here, what's going on in the Northern California, San Francisco Bay Area. But things have changed drastically, as you know. So anyway, let's go getting back to this active listings, price reduction. And then, of course, since the sudden skyrocketing of interest rate from around 3.5% early this year, 2022, now 6 months later, 7 months later, now we're talking in November. Wow, time flies. Right now it's already November. And we have seen price listings went way back up for the past 7 8 months steadily on. So yeah, that's what's happening. So we need to be seen what's going to go beyond that. So the big question, this author says, how long will the market contraction last? And when should we expect things to heat back up? Wow. Those are good questions. I have my own thoughts. I will share that with you throughout this video presentation. So let's look at what the data can tell us. The first question is, home buyers got spooked when mortgage rates passed 5.5% back in April and May and June, right? So we have experienced this amazing volatility. And so this article goes on to say that when the rates went from 3 to 6%, we saw inventory rise as buyers pull back, of course, due to affordability factors. Rates peaked in late June and then fell back down to around 5% in July and August. Then actually buyers actually perked up a bit and got more active. However, and then it says we could measure this change because inventory stopped rising nationally during those months. But then, as soon as the rate spiked above 5.5% in September to 6.5% and even 7%, currently buyers once again stop abruptly. Inventory and price reductions have resumed climbing now. Yeah, so far so good. I've been talking about it on my other videos. So in case you have not watched my past videos, please go to YouTube, Google, and find my past videos that talk about the trends throughout this year. So the key takeaway is, when imagining the possible outcome for the 2023 market next year, it looks like that 5.5% threshold may be very important. We could see demand return in the next time the mortgage rate drop. I tell you, I could not agree with him with this article more, because it's all about interest rate, right? So remember, during the pandemic boom, 2020 to 2021 and beginning of 2022, the interest rate dropped around, let's say, 3.5%, and the inventory level at that time, like 1 month or a month and a half supply of the inventory. Then, of course, you see the housing market boom in many parts of the country. Now the inventory level is kind of similar, depending on which market. But right now, the only issue is 7%, right? And that's stopping everybody. If the interest rate reduce gradually, hopefully sometime next year, to 6% and even to 5%, and the inventory is very, very low, even on a historical basis. So I feel that we are going to see some interesting market dynamics. And because right now the sellers are not selling, they are locked into the very low interest rate. So everybody pausing, the earth stood still. There's a movie name, The Day the Earth Stood Still. There's a movie back in 1950s, one of those scary movies about the world coming to an end, I think. Anyway, well, just it goes to show you, I'm a little bit older than many of you. All right, so yeah, my takeaway is, if the mortgage interest rate drop back down to 6 to 5.5% sometime next year, wow, I think this market frenzy may start again. So what's the additional takeaway on this paragraph? So I would, let me share my screen. I would recommend that for those of you that can afford it, for the primary homeowners out there, if you qualify, if you can afford it, you should get in right now, even with a higher interest rate, because you can always refinance later. And so you buy the asset, you buy the house, and then just let the benefits of ownership help you long term. But for risk investors, I tell you, there's no time to waste. Target a specific market, hopefully a low price market where you can cash flow with 25% down payment, even at 7 to 7.5 interest rate. Sit on the break even to slight cash flow for now, and when the rates goes down, there is some market frenzy for investors as well. So just keep that in mind, because I've been doing this for a very long time, helping people buy investment properties. And right now is the best time to pull the trigger. The cash flow is not going to be that high for the time being. but things are looking good, especially when the interest rate dropped to 5.5% based on this key takeaway from this first paragraph. Does it make sense? Oh, by the way, I would love for you to drop some comments on below this video. I'll be more than happy to address them and answer back. So the second question is, there's a chance for more pronounced inventory growth? Maybe, we'll see. The only way I see inventory growth is the builders start to build again. They are doing some temporary pause as a result of the lower demand. And in fact, they are trying to get rid of their excess new construction inventory, in case you have not heard. So in fact, there's an opportunity to buy new construction homes at a slight discount and with a lot of incentives in many good markets, especially in the South and Southeast, and maybe in the Western region. So there's a chance for more pronounced inventory growth. So this article says, we're expecting inventory to grow throughout the middle of October, but if buyers continue to stay on sidelines, which is the case, I believe, 7%, just the buyers are being spooked. That is a very good word, spook. Yep, ooh, spook, Halloween, oh, Halloween, everybody getting spooked. Then inventory could continue to grow late into October and into November, which would be very unusual. The holidays see far fewer sellers, which is the case, right? Every year is a seasonality. For the rest of this year, 2 months left, we're going to see very little activities, selling and transaction activities, no matter what. So yeah, most sellers will wait until January to list their homes, but there are always some sellers that want to sell for whatever reason, mostly in a slightly stressful situation. But so the key takeaway on this second paragraph is, if inventory grows late in October or into November, then a bearish signal will be lit for home prices in the future. Well, we'll see. All right, let's look at the inventory from a national perspective. I know every local market is different. I've said that many times. There's no such thing as a national real estate market. Every specific sector of the U.S. is very, very different. The West real estate situation is very different than the South, very, very different than the Midwest, and very different from the Southwest. Okay, so inventory, national USA weekly, single-family homes. If you look at the past 7 years of trend, the benchmark, let's start at 1.2 million supply of inventory back in 2016. In case you have not noticed, we have been ever since the last housing crash back in 2008, there has been very few homes are being built. The supply of homes has been have not met up with the demand for the past 15 years, and right now we are, at the past few years, we are paying the price. Am I right? So we're seeing some systematic low supply of inventory from 2016 all the way until the pandemic right here, okay, which is this 2-year run up, 2020 to 2021, and part of 2022, we have seen historic home price skyrocketing of prices. So right at this area, then which is and then inventory come down drastically, then come. So we are way behind the healthy inventory level and in a healthy balance of supply versus demand at this point. We are more than 100% short of inventory level to meet the housing demand moving forward. Okay, so the bottom line is economics 101, low supply, high demand. This means housing prices will go up. All right, so if anybody disagree with me, please make a comment, because you're not gonna be right. Fundamentals, economics 101, low supply, high demand equals housing prices will go up. So third paragraph, we still have a significant shortage of homes available, and that's what this article says. Given that we may see unseasonal inventory trends in the coming months, as I said before, I now anticipate that will end the end of the year will be around a little bit less than 500,000 homes for sale. So at this moment, most homeowners are locked into the lower interest rate, which is very true. They have solid equity in their homes and they have jobs. They don't have to sell it. So it could take several years of higher interest rates to get us back to the previous quote unquote normal level of active inventory. It will take several years. Some experts say it will take up to a decade for us to catch up with the lack of supply of inventory. So it remains to be seen. Only time will tell. So clearly, the writer of this article, Mike Sorensen from Altos Research, are making these comments, and I trust his knowledge. So the key takeaway in terms of a significant shortage of homes available. Oh, by the way, 6 months, 5 to 6 months is a normal balance of supply versus demand. In most markets, based on my extensive research, as I do these videos from using several credible sources, most housing markets, specific market regions, they have like 3 to 4 supply of inventory. So that's way before 5 to 6, below 5 to 6 months. So it's still a seller's market, still very low inventory, no matter how you look at it. So the key takeaway from this article is that there is no tsunami of listings coming to the market while home prices are dropping in many areas. These restricted inventory may help prevent crash, right? So to paraphrase, there's really no risk of crash at this current situation, because the sellers are not selling, they're staying put, there's a low inventory, there's very little distressed sales, there's massive amount of equity the homeowners have, and in fact, 40% of the mortgages are free and clear, and like a large percentage of the mortgages are locked in at 4% rate or lower. So there's very little incentive or motivation for any sellers to sell. Of course, there are always exceptions, as we've seen. Okay, so hopefully I make that very clear. So no risk of crash at this moment because of very low inventory, and people have substantial equity of their in their homes, and they have very low mortgage interest rate. And the fourth question is, some markets are hurting more than others. So I couldn't agree with this article more. Some markets are hurting more than others. I know in California, where I live, yes, there's a lot of price reductions. No surprise to me, right? California has always been a cyclical market. But like the other sub-market like Boise, Idaho, Salt Lake City, Las Vegas, Phoenix, yeah, they have some fairly significant, 10%, maybe even 15% price reductions, at least temporarily, because it's a boom town. They have went up so fast during the pandemic, and they are coming back down, at least temporarily. But in the other markets of the U.S., especially in the Midwest and South and Southeast, you're not going to see, those markets are very stabilized. We have not seen much reduction in those markets as well. And all my other videos, we cover that. So just watch for my other videos, and you will see why many markets are still doing very well, contrary to what you think. Okay, contrary to what the media led us to believe into thinking. Okay, the media want to manipulate the real estate market. You have to determine how are you getting your information. Don't go to those clickbait YouTube crash videos. Come on, you're better than that. So okay, let's go further. Some markets are hurting more than others. Yes. Let me see what else. Take Boise. This article is targeting Boise. Boise is a good market, but I don't know. but as the poster Boise is the poster child for boom to bust, right? So some of these markets, people like, for example, not only Boise, like Las Vegas is also Las Vegas. Las Vegas went through a crash, and Phoenix, Arizona, likewise. Back in '08, they went through a big housing crash, and now people pick on Boise and Phoenix and Las Vegas. I don't know. I mean, that's a lot of exaggeration. Yes, this boom to bust market is going through some correction right now, some price drops, but I don't even expect a housing crash even in this boom to bust market, because they have good economics. They have very good growth potential, and they're located in the Sun Belt, except Boise. And the prices are still fairly affordable in these markets, in these boom towns, if you will, but nowhere near the prices of California. All right, so I wouldn't call this a doom and gloom situation. So yeah, price reduction, Boise versus New York Metro. I know. I mean, I'm not even gonna go through this because they are stating the obvious. So finally, the key takeaway from the altosresearch.com, as I mentioned, from this, is that it remains to be seen whether markets like Boise, Idaho, or the canary in the coal mine, or if some markets will weather the storm fairly well, even in the face of significantly higher mortgage rates. We'll be watching our data closely. So I like a lot of the takeaway. My takeaway is such that, yeah, some markets are hit harder than others, but the real estate is local. So whether you want to buy a primary home in certain part of the U.S. or whether you are a real estate investor, you need to target a specific market, learning as much as about it, because many markets out there, as I told you earlier at the beginning of this video, there are a lot of sub-markets in the U.S. are doing very well, especially in the south and southeast. Right. So if you see a lot of value in this video, please smash the like button, and also subscribe to my YouTube channel, and to sign up for my newsletter on my website so you can learn more about real estate investing. Okay, thank you so much. This is Siwin Yi from the Yi Real Estate Network. Thank you for watching. I will see you shortly on my next video. Bye-bye.